Let's face it, cyber attackers have the advantage. Extra Hop is on a mission to help you take it back. Regain the upper hand with security that can't be undermined, outsmarted, or compromised. When you don't have to choose between protecting your business and moving it forward, that's security uncompromised. See how it works in the full product demo, free online at securityweekly.com/extra hop. Did you know that 81% of data breaches are caused by weak password security? Keeper Security's easy-to-use password manager platform keeps your passwords safe, easy to share, and out of reach of cyber criminals. Keeper is the leading cybersecurity platform for preventing password-related data breaches and cyber threats. Check out Keeper and get a free 3-year Keeper Password Manager solution when you take a demo of Keeper for Business. Learn more at securityweekly.com/Keeper Security.
Welcome back to Enterprise Security Weekly. Throughout 2022, CRA's Business Intelligence Unit will be releasing research reports on the top topics across the security industry. Our first report will be on third-party risk and the supply chain. To participate in the survey, please visit securityweekly.com/third-party risk. And really appreciate you filling out these surveys. It's great data that's going to get released to the whole community. Definitely urge you to do that. And we will share the results in our third-party risk e-summit in January. All right. And for our second interview today, been waiting a long time to get Jeffrey Smith back on the, just to get to talk to him again. We went a while without chatting. And, we chatted a lot in the past about cyber insurance. And definitely going through a lot of changes these days, thanks to ransomware, now becoming kind of the preferred method of shaking down businesses and getting paid. And Jeff, I was gonna go into your bio, but I think I'll just let you kind of tell how you got into cyber risk underwriting and how you got into this field.
Sure. So I've been in the commercial insurance space for 25 some odd years. And it was about 5 years ago that I started looking into the cyber insurance space because it was new, it was interesting, and it was completely different than what I'd been doing before. And I saw the exposure increasing. And so I opened up this shop, and we're technically a wholesaler, and we can talk about that in a second. But we do have some underwriting authority on behalf of some insurance companies, and we focus on what we call small to medium enterprise risks. So usually risks under, say 5,000 employees. Most of our stuff is, I'd say companies under $100 million in revenues.
Okay. And I guess let's talk a little bit about how cyber insurance used to work. Maybe when you got started out. I think it was a lot simpler than how it works today. Especially like the application process, the getting a payout. That all that stuff.
Well, that's an understatement. I think when we first met, Adrian, we could get quotes based upon I think there were 5 or 6 questions, and 3 of them were name, address, and website. And that was mostly for the small to middle market risks. The upper level risks, the enterprise risk, have always had required a little bit deeper dive for underwriting, and that has changed dramatically. Right now, for example, I've got 3 deals sitting on my desk, and they're renewals, and the price increases range from 75% to 200%. And the amount of data that is required to, provide to get these things underwritten is increased. Now we're talking about 5-6 pages, which includes like ransomware supplements and things like that I'm sure we'll get into before the end of this visit.
Yeah, so I went out and asked people to submit their questions. I don't know if you saw that email from me, but I got so many questions. There's no way we could get to all of them today. So I was thinking maybe we go with your experience, because I'm sure there's a lot of questions that you get over and over and over again. again. So maybe if we just start with your frequently asked questions, the questions that you get, especially around how it's changed in the last year or so.
Well, I'll focus in on questions I get from the InfoSec space. And I still get questions about, do we pay claims? And I've talked about this extensively on other podcasts and certainly at Black Hat. And I think one of the questions had to do with my lawyer said that they don't pay claims and stuff. You can give that lawyer my phone number because I'd love to talk to him. The reputation of claims not being paid had to do with early on with coverages that weren't provided, and then in the last couple of years had to do with insureds who didn't buy standalone cyber insurance trying to file claims against their other insurance policies. A great example is Mondelez and the NotPetya quagmire. Mondelez didn't buy a standalone cyber insurance policy, and that's that's the one big one that made the headlines, and people, particularly in InfoSec, pointed to say, this cyber insurance is a scam. And in fact, they did not buy a cyber insurance policy. Merck had, large claims as well, and they collected in full. But there are coverage grants in other insurance policies, so there's coverage overlap. So in the case of Mondelez, it was a global property insurance policy. And so there is some limited data recovery and maybe some business interruption coverage in those policies, but I have no idea what their policy was like or what was in it. So there's still some confusion about that. We have not, I think last I spoke to a couple of my larger insurers, and they're paying, 90 some odd % of claims that come in. Claims that don't get paid are ones that, either there wasn't suspicion, it was, let me think of one good example. There was a submission for, I think, some bricked computers. The allegation was that the computers were bricked. It turns out the computers were not bricked. The insured went out right after the claim and replaced a bunch of servers, and then expected the insured to pay for them, even though they were not bricked. So we see isolated instances like that, but from my experience, we really haven't seen a standalone cyber insurance policy not pay a claim. Certainly not for legitimate reasons.
Right.
In terms of the evolution of the product, early on it was a mad dash. All the insurers who provide commercial business insurance said, "Hey, this is a new thing. It's the only line of coverage that's actually growing. We've got very small market penetration, and it's going to be the next big thing." So, 600-700, maybe more insurers started to provide this coverage in some way, shape, or form. Most of them would add, endorsed coverages onto their existing commercial policies. But we're now seeing a pretty big shakeout of the insurers because they're paying claims, and they're starting to see that not only do they have specific exposure to individual risk, but they have what we would call I guess systemic risk or supply chain risk, where there could be a hack and they could be on they could provide coverage for 3 different entities in the supply chain who are affected. So you have they call it silent cyber. So, that's another big issue. A lot of them started to figure out. And the other thing to keep in mind is that, these insurers have, for the most part, buy reinsurance to some level. And so there's a finite number of reinsurers who are big enough to, be able to assume these exposures. And they're looking at that silent cyber and supply chain risk. So they're starting to pull back on, who they're allowing to underwrite in their behalf, and the types of, the size deals that they're willing to provide behind these insurance companies. So there's a lot more scrutiny from the reinsurers on the insurance companies who are writing cyber. And so as a result, now we're seeing, as I mentioned, depending on the risk, I'd say the minimum 30% increase is what we've seen. Certain classes of business, we're seeing, as I mentioned, I have one on my desk. It's a healthcare company, and it's 200%. And, it has to do with there's an aspect of growth involved in that. The company grew, but it wasn't commensurate with, the 200% increase. And that was the market across the board. The incumbent felt like they underpriced the product last year, and the market is actually proving them right now. So the other big development that's really important, in my view, is that the underwriting has gone from trying to apply traditional insurance underwriting tenets, such as using, large amounts of actuarial data, to companies now starting to run, vulnerability scans and using that and deep dives and things like that hackers and InfoSec companies use to actually underwrite. And we're seeing more and more alerts during the policy period. A lot of our insurers, they're more insurtechs now, and they provide, ongoing, monitoring and alerts. And this week, I've gotten alerts on 6 or 7 of our insureds that they have a port open, or they have some end-of-life software, or, they've got Microsoft Exchange server or SolarWinds. And so we're getting a lot of alerts like that. And the good news is that we're able to actually provide a value add by going back to our insureds and helping them, plug these gaps. So I would say, the 3 different, changes that we're seeing is that, we're seeing a shakeout of players, and they're starting to, I think the industry as a whole is starting to get better at actually underwriting this. A lot of the players are trying to decide if they want to stay in the business or not, because it's going to require more of an investment. They're going to have to start using more information security tools to actually underwrite this stuff. The market, prices are going up. We're starting to see a lot of markets require an additional deductible in the form of co-insurance on ransomware extortion claims. So an example would be you have a $25,000 deductible, but if it's a ransomware claim, you may have to take 20% of what's ever paid out. A lot of the insurers feel like these insured should have some skin in the game, with respect to, the ransomware claims, because they're really driving loss results. The other, coverage where we're seeing a lot of activity is in the funds fraud area, the social engineering. And, 3 or 4 years ago, it was not uncommon for us to be able to get $1 million of coverage for, what we'd otherwise call cybercrime. And now, certainly in the middle market, it's in the upper market, it may not be offered. In our space, it's $250,000 max. And a lot of times, even with that coverage, there's increased deductibles that apply beyond the policy deductible. So I'm not sure if all that made a lot of sense, but that's my perspective.
Yeah, no, that is. I'm going to throw out some questions here that are probably some super basic, stupid questions, but I consider myself a moderately smart person. And if I have these questions, I'm sure a lot of our audience does. Help me understand how cyber insurers truly gauge the risk in order to determine the cost, right? Because you said the cost has gone up 200%, 300%, whatever the large eye-popping numbers that you quoted. Like, what changed other than we're seeing tons and tons of claims? Is that the primary determination for the jump in cost? Or is it more like, okay, we have a better capability to quantify risk, we have a better capability to understand based off of your size, shape, scope of your business, your company, your tech profile, whatever it might be, to determine the chance of probability of loss. That's why we're raising it. Can you give me a little idea there?
Well, I think that, in my opinion, there are a couple factors. One is they're getting better at quantifying their risk, or at least, they're able to do, I think, a better job of quantifying risk. And instead of just asking, what are your revenues? How many records do you have? Do you encrypt? Do you have backup? Now we're getting into, MFA is a big deal now, because they're getting a lot of claims that involve, where MFA could have prevented it. EDR is a big deal. They want more specifics about backups and segregation. So there's a lot more detail that goes into it. And then in terms of the market in general, I haven't seen any data that suggests that, that would support like a 200% increase in premiums. I think that has a lot to do with fear and restriction on capacity. The concern is that everybody's seeing these claims, and a lot of insurance companies who were just sticking their toe in the water here are saying, wait a minute, maybe we don't want to be in this business. Because they're starting to see, as I mentioned earlier, they're going to have to start making investments. If they want to do this right, they're going to have to start making investments in some information security technical expertise. And that's a big change.
Literally, one of the questions we got is, anyone making any money on cyber insurance?
Oh, sure. I don't see companies losing money. It still performs much better than standard property and commercial property and liability policies. Those margins are pretty thin. The margins are still pretty rich as far as I can see with the markets that we work with. Again, it's just a heightened awareness. You're also seeing an increased demand, and the demand is coming from, certainly from, the headlines and that some of these commercial enterprises or public entities that haven't bought it before starting to really see that it's a big deal. We're seeing a lot of it driven by a requirement for, public entity or commercial enterprise to actually buy the coverage. And we recommend to our insureds that they require anybody they do business with to buy the coverage and to name them as an additional insured on their policy. So again, a lot of it's coming from contractual obligations. So, for example, if you're let's say you're a large physician practice and you have a transcription company and a billing company that you contract with, you're going to want them to have cyber insurance. And you're going to say, we need you to have cyber insurance, and we're not going to work with you. Conversely, we see companies come to us and saying, hey, we're a health insurance broker, and Anthem's telling us we need a ton of cyber insurance. And so we're seeing companies, there's always contractual obligations surrounding commercial insurance. We want you to have property insurance. We want you to have liability insurance. We want you to have this protection. Now cyber insurance is becoming routinely added into those contracts.
Does that become cost prohibitive for small and medium enterprises? If you're a large company working with a smaller company and yet you're requiring the smaller company to have this insurance, you're talking about anywhere between a 30 to 200% increase in premiums. That could bury a smaller company along with some of the requirements that I imagine are in the requirements forms to actually even get cyber insurance. If you're a smaller company, you're probably not going to have everything that's required to meet the minimum to actually be covered.
Great question. Well, it's all this discussion about big increases. It's important to keep in mind that it's a relatively modest spend relative to other insurances that these companies purchase. So, again, we focus on, small to middle market companies. I would say our, typical premium for, a $5 million, physician practice or professional services firm, maybe $5,000 to $10,000. If we've seen a lot of situations where we have companies coming to us and saying, hey, we're trying to get this contract with let's say Anthem or whoever, one of these big Fortune companies, and they're telling us we need $20 million worth of cyber insurance, and they're a $5 million company. That's a challenge because insurers don't want their policy to be the biggest asset on an insured's balance sheet, right? So that becomes, that could be prohibitive from the perspective that they're going to have a hard time qualifying for that, that contract, because getting $20 million of cyber insurance for a $5 million company is very, very difficult.
Right, and it gets into the idea of supply chain. It's a different supply chain, of course, than the question I'm about to ask. But, it is that trickle down effect. And there has been some movement in the industry to talk about software bill of materials, SBOMs, and protecting companies, and certain companies requiring others to list their software bill of materials before they'll work with them. Does that impact insurance? Do SBOMs impact insurance? How would it impact insurance? How is it tied to this whole idea of the supply chain as it relates to both coverage and getting claims paid when and if there's an issue?
You used a term I'm not familiar with, I think, or maybe I misunderstood you. The supply chain.
So the software bill of materials is basically just it's a recipe of all of the quote ingredients that would be in software. And there are certain companies and there are organizations that are pushing for an SBOM bill, a software bill of materials bill, that would require, in particular, the government, but other private enterprises are also looking at the idea of requiring their vendors to supply a software bill of materials to show where the software comes from, what's in it, just like a recipe. Just like, if you were making cookies, you'd have to list out the flour, sugar, butter, all of the other ingredients.
The saturated fat. Yeah. So, I mean, the supply chain is an issue. I've seen some insurers say, we don't want to be in this certain industry space because we have a big book of business that's, that are suppliers to that space, for this very reason, if that makes any sense. So, again, the issue is, and the reinsurers in particular, who are the foundation of cyber insurance, they're looking at this, and again, the supply chain's a big concern of theirs. They're concerned about, I think I've used this example, maybe I've shared it with Adrian before, but the big Quest Diagnostics and the other big LabCorp. They suffered a pretty big breach a couple of years back. And they didn't do anything wrong. They had contracted with a billing company who contracted with a collections agency. And the collections agency was a little tiny company. Well, the collections agency got hacked, went through the billing, and got to LabCorp and Quest. And, there's a big concern about that. So as a result, getting insurance coverage for, a collection agency, it's doing business with a healthcare company. They're not easy. There are only a couple markets that, that will do those sort of risk, and they got to be really clean. So I'm not sure if that answers your question.
Yeah, I think it's, a tip of the iceberg that the supply chain is becoming more important. It's always been important, of course, but there's a little bit of a heightened focus on it now as it relates to everything, whether it's contracting, whether it's insurance. It's very, very important. And, just like we want to know how much saturated fat might be in the dinner we make, we want to know where our software is coming from and how it's built.
Yep.
Yeah. So, one of the more common questions that we saw popped up was around, and I want to make sure you can hang out, Jeffrey. I don't know if you had.
I got plenty of time for you.
Okay, cool. One of the questions was around, and you've kind of alluded to it, what makes a premium more or less expensive? How much can the buyer do about lowering their cost or identifying what's raising their cost on that 5 or 6 page application you were talking about?
Well, again, MFA is a big thing. So, we have some markets who, they won't write a risk unless they have, MFA on, remote network, any sort of access. So that's a big one. And it's not necessarily a disqualifying, issue. Some markets, it's a disqualifying issue. They just won't write it. There's varying degrees of underwriting. What's the word I'm looking for? Underwriting criteria, appetite, between insurers. So like a couple of the insurtechs we do business with, and I call them insurtechs because they're, a couple of good examples are a group called Coalition. another group called At Bay, another group called Corvus, and they started, their facilities with tech people, people
Right.
who have hacking or security experience. And so then they built the insurance out around that. And so they, I think, do a much better job. And let me back up. That's starting to spread to some of the traditional providers. So some of the providers who have huge market share, some of the Lloyd's facilities, some of the, domestic insurers who've been doing this, they're starting to use, vulnerability assessments at a minimum as a part of, their process. So, how you score on that can certainly impact your pricing. If you have, if they detect Microsoft Exchange Server, you're going to have to get that fixed. Some of them will pick up on it. Some of them won't. If they pick up on it, they're going to say, here, we're going to have to help them. Here are the steps that you need to take to fix this. And, we see that. I've seen that on maybe 20% or so of the submissions that we've seen lately. We've seen it come up, midterm because it just became a thing not a year ago or so. And so we're starting to see the existing insurers are starting to get alerts, as I mentioned to you earlier, from some of the markets we use that actually monitor these networks during the policy period. So those are factors. When the smaller risk, we don't, again, the smaller risk for really small, I call them micro-sized placements, placements that are under $5,000 in premium, usually, can get by with the one pager, again, depending on the class. Much larger than that, once you get, above, say, a $10 million company, you're going to have a ransomware supplement. And, again, they're going to cover things like they want specifics on, system configurations, administrative privileges, EDR. Again, the MFA is an issue. They want to talk about segmentation, and they want to get, real specific about backups. They want to see, training, how often, they want to see if you test your backups. They want to see if you test your, your contingency plans. So, by varying degrees, and I think the industry is heading this way in, as a whole, because they have these tools. They don't have losses. They have some losses, but I think they're starting to figure out that actually using tools like you guys use or give them, from an individual risk perspective, a much better means to price a product in terms of debits or credits on the base rate than traditional underwriting.
One of the things you mentioned earlier was reinsurance. And one of the questions we got, so I don't remember what reinsurance is. So if you could explain that. And then one of the questions we got was, do folks that do cyber insurance carry a higher reinsurance load than for other types of insurance?
Yeah, that's a good question. I'm sorry I get carried away. Realizing
no, that's okay.
Insurance is goofy. So let's walk through. So let's start with an insured. So Adrian, you're going to buy a cyber policy. First thing you're going to do is you're going to contact a broker or an agent who represents a bunch of different insurance companies and hopefully has a clue about cyber insurance, because a lot of them don't. And you're going to say, here's my application. I need cyber insurance. The retail agent will turn around and will either go direct to some traditional insurance markets, or they'll go through somebody like me to access what we call wholesale markets that are only accessible through wholesalers like myself. And then we go to the insurers and with your application, and we get quotes. The insurers, in turn, once a year, just like you would have to renew your policy once a year, the insurers, for the most part, there's some insurers that are so large they don't buy reinsurance, but the insurers will go out and buy insurance for themselves. So it's insurance to protect them from underwriting losses and to provide capacity, as we say, for them to take premium. So capacity is just how much money you have to have aside to accept a certain level of premium, and there are ratios involved, but we don't need to get into that. Reinsurance is insurance for insurance companies, and the concept of insurance is to spread the risk of a few amongst the many. And so that's how if you had a claim payment on your policy, we could have hundreds of insurers that have a piece of that claim. Hundreds, is an exaggeration, not so much in the old days with Lloyd's and stuff, but you're going to have more than a few insurers who are going to be impacted by that claim.
Right. Yeah. And that's, I suppose that's why I've heard of people saying that they've got like 10 $5 million policies to get up to the level of insurance that they feel like they need.
Yeah, that's a thing where, if you need big limits of insurance, companies say, hey, well, we can write $1 million of coverage. We can write up to 5 million. We can write up to 10 million. But usually, again, that's kind of risk spreading. So we have one now that's buying 30 million, and we have 4 players. We have 4 different insurers on it. You have one primary insurer who sets kind of the base rate. And then you have the other excess insurers come on top of that, and they price based upon that base rate. And so the primary carrier is closer to the fire, right? Because they're going to pay the first 5 million of any claim in this example. So, the pricing in theory, not always, but in theory, is reduced. So maybe let's say for the first 5 million policy, you'll pay, $100,000. For the next 5 million, maybe you'll pay 60,000, and then 40, and then 20. That's how those are put together. But that's, that's insurance companies and their, what we call their capacity, which is, again, the limits they can put out and the amount of insurance they can sell. Some of them are bringing their capacity down. Some of them who used to be able to put out a $10 million policy are only putting out 5 now.
So last question before we wrap here, we made a dent in the questions I have. We didn't come close to getting to all of them, but, a bit of crystal ball gazing, do you have any feeling for what pricing is going to look like in the future? If it's going to just continue to go up, or is it highly dependent on what happens with extortion payments and stuff like that in the market? Or do you think it's a bit reactionary and it's going to level back out, or something else?
I mean, yeah, it's going to be, typical, life cycle for certainly most products is, you're going to have the growth, then you're going to meet some sort of equilibrium. I think we're going to see the trend going up because you're just running into a supply and demand issue. A couple of years ago, maybe we had, I don't know, maybe the most credible information I had at the time, maybe 3 years ago, was that maybe, 30% of businesses, small to medium sized businesses, were actually buying cyber insurance. And now that's up over 50% based upon what I'm hearing. And it's increasing because we're getting a lot of net new submissions from insureds who historically have not purchased this. We're getting a lot of people calling us up where we put out a proposal 6 months ago saying, hey, they want to buy that now. So, the demand is going up, and the exposure is starting to become better understood. So my guess is that this, there's going to be, the market's going to continue to correct itself until, it gets to some type of equilibrium. But I think we got a ways to go. I think, there are a lot of insurers who have, like I said earlier, been sticking their toe in the water in cyber insurance and starting to realize that maybe they should stick to their real knitting. So,
right.
Yeah.
All right, Jeffrey, thank you so much for joining us today. I feel like we've dented the surface, but it was a good sized dent. Maybe we can have you on again sometime in the future. But thanks for enjoying us, or thanks for joining us today on Enterprise Security Weekly. For you, Adrian, anything. Thank you. We'll be right back in a few moments with the weekly Enterprise News.